As I sit here, stock markets are still feeling pretty sorry for themselves, with only traditional haven assets such as high-quality government bonds, the Japanese yen and gold offering any shelter at this tricky time. Now, we're going to get a good chunk of news flow in the coming week from quoted companies, so they'll be letting us know what they think of the world right now, and that could be quite important for broader sentiment. Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this week's edition of our regular Markets Review Breaking the Mould, I'm going to look at three stocks that have enjoyed, if that's the right word, contrasting fortunes over the last 12 months. Each of them is due to report full year numbers next week, and all are capable of causing a fuss. They are Reckitt Benckiser on Monday the 15th, Anglo American on Tuesday the 16th, BAE Systems on Thursday the 18th. Now, Reckitt's been the best performer of the three over the last year, rising by around 7%. The health to hygiene play offers products like Nurofen and Silitbang, and as such has fairly defensive qualities, while its power brands bring it some pricing power, as reflected by an operating margin north of 20%. So for every £1 in sales, it bags 20 pence in profit, very crudely. For the full year, management has guided to like-for-like sales growth of 5% and a further increase in the operating margin, so watch out for those metrics in particular on Monday the 15th. Overall, analysts are looking for a 3% increase in earnings per share to 241p and a dividend of 122p, in line with Bosch Rakesh Kapoor's plan to distribute half of earnings as dividends, although that still represents a drop in the payout year on year owing to the 2014 spin-off of pharmaceutical business Indivior. At a share price of about 60 quid, Reckitt offers a yield of around 2%. Not huge, but it is twice covered by earnings. Next of our three to report will be Anglo American on the 16th, easily the worst performer of our trio, down 67% in the past year, even after a wild rally in the last month, as this chart shows. Now, that surge has been sparked by January's production report and also December's strategic review from boss Mark Cutifani, who outlined cost cuts, capex cuts and dividend cuts, taking the final dividend to zero, and there's no plan to pay one at all in 2016. Now, the headline numbers are going to be messy, owing to asset write-downs of around $4 billion US. So one thing to focus on will therefore be the net debt figure, expected to be around $13.5 billion. In addition, analysts are going to be looking to see whether the firm launches additional cost and capex cuts beyond those already outlined, and also if it's planning any more asset disposals. Commodity prices are still weak, and the company may need to show it's doing even more to shore up its balance sheet and defend earnings. Finally, we come to BAE Systems, a global defence equipment and services player, and their shares have fallen around 10% on the year. Now, aided by a bit of juggling with some overseas tax positions, BAE Systems has guided towards earnings per share growth of around 38p for the year, and November's trading statement did reference, quote, an improving business environment. It'll therefore be interesting to see on Thursday the 18th if that has begun to show up in the order book, which fell from north of £40 billion to just over £37 billion in the first half. The dividend may also signal management's confidence in the future. There was a small increase in the interim payout, and for the full year consensus is looking for around 20.8 pence against 20.5p a year ago. Now, that's enough for a 4.4% yield on the current share price, with earnings cover about 1.8 times, a bit less than the ideal of 2, but it's something which may at least titivate income hunters and persuade them to do some further research on the company. Thank you for watching, and I look forward to seeing you next time.